What's up, guys? Jonathan Rose. Today we're going to talk about why was the stock market up when we started, why is it down, and how we could take advantage of it. Specifically, trading futures. We're going to talk about S&P futures, Nasdaq futures, Dow futures, and how to compare and trade one against the other. So S&Ps, let's look at the price action for today. Wednesday, gap up. It's kind of the strongest it was all day. Fell off. Not really that much going on, right? If we look on a longer term chart, whenever I'm doing technical analysis, I want to look at the most amount of data first. So I have S&P futures in front of you going back to 2016. Without a doubt, the key number is going to be this 100 period moving average, 2607. The last time we hit this 100 period moving average on a weekly was the beginning of October, and then taking us back to the end of August. So that's really the core number or the main number right now. Market rallied, came off, really not that much going on. Here's where I think there is some opportunity and a trade I've been watching very closely. Here's what I did. Instead of the S&P futures, which I analyzed, I looked at them relative to the Nasdaq, relative to the Dow, just trying to see what's expensive and what's inexpensive, always looking one relative to the other. In front of you, I have the Nasdaq futures and I have the Dow futures. And I just did Nasdaq minus Dow. And what that's showing me is the relative difference between the two. I'm on a 4-hour chart using Thinkorswim going back to April of this year. And you can see pretty strong relationship. A mean reverting trade. When we're up here, the Nasdaq's expensive relative to the Dow. It doesn't mean the Nasdaq's expensive. It means the Nasdaq's expensive relative to the Dow. When we get down here, the Nasdaq is inexpensive. We also look at this by using something called a Z-score. Now, Z-score, it's not a fancy indicator. All it is, it's just pure math. It's just telling me when is this relationship 2 standard deviations away from the mean. When it's 2 standard deviations above the mean, we're going to get way up here over 2. You can see here, 2 standard deviations above, 2 standard deviations above, 2 standard deviations above. When it gets below, same thing. Below, above, and then it gets really below down here, which happens to be like the bottom of the range. So this is a really reliable spread, but this spread also gets really good when volatility kicks in. When volatility kicks in, relationship trades between highly correlated products present the most opportunity. And if you take a step back and think about that, when there's not a lot of volatility and 2 products are so highly correlated like the Nasdaq and the Dow, or Nasdaq and S&P, or the S&P and the Dow, you're not going to get a lot of movement. You're going to get a lot of this price action because there's not a lot of volatility. But all of a sudden, when vol really picks up, that's when people are forced to do things. There's margin calls. Maybe tech's leading the way. Maybe the Dow's leading the way. Maybe the S&Ps are leading the way. So how you can look at this, or how I'm looking at it, is just draw a line up here. When the Nasdaq Y or YM relationship gets up here, you could do a few things. You could sell 1 Nasdaq and buy 1 Dow. This will get you short. I would only do this when we're 2 standard deviations above the mean. But you could also do outright trades if you don't want to do spread trades. So when we get up here, the Nasdaq's expensive to the Dow. If you want to sell something, if you want to get short, sell Nasdaq, don't sell Dow. Also, when it gets up here, if you want to buy something, this is when you don't want to buy the Nasdaq, because the Nasdaq's expensive relative to the Dow. You're better off buying the Dow. Now, this is very different than a lot of you trade. I wanted to make this video to show you professionals look at things from a relative value standpoint. Right now, S&Ps are kind of in no man's land going down to that 100 period moving average. But if you're looking for opportunities, I highly suggest you mess around with the different relative value relationships. Nasdaq against Dow, it's simple. It's just 1 by 1. Z-score, if you want to know more about the Z-score, email me, support@activedaytrader. Hope this helps. Leave a comment below if you have any questions, Give it a like. Thanks a lot, guys. My name is Jonathan Rose, and I'm the owner of Active Day Trader.